Hey, money family, welcome back to Beat the Bell. I am Dominique Broadway, and let me tell you something. We have so much to unpack this week. From Venezuela shaking up all of the energy markets to Friday's job report that had Wall Street doing a whole double take, plus Trump's credit card announcement that could honestly change how you use your plastic. So this week is really setting up to be absolutely crucial for your money. And if you've been waiting for the right time to position your portfolios, this earnings season is officially kicking off, okay, this week. And I'm going to tell you exactly which companies you should be eyeing and keeping your eyeballs on, okay? So let's get into it. First things first. All right, let's start with what's been moving markets over the past week. And that's the ongoing situation that is happening in Venezuela. For those of you just catching up, the military operations and political instability that we've been watching has continued to create tons of ripples across energy markets now. Venezuela isn't a major oil producer anymore. They're producing around 700,000 barrels per day compared to nearly 3 million back in the day. But here's why it matters for your wallet. Market uncertainty always shows up in energy prices first. And energy prices, well, they affect everything, believe it or not, everything that you buy. Over the past week, we have seen oil prices fluctuate between $72 and $76 per barrel as traders try to price in potential supply disruptions. That volatility is why you're seeing gas prices jump around at the pump, okay? So here's your money move for the week. If you're driving more for work or planning a road trip, lock in gas prices right now when you can. And if you're investing, energy stocks have been getting a nice little boost, okay? Companies like Chevron and ExxonMobil saw modest gains last week as the uncertainty premium totally got priced in, okay? So the key thing to understand is that geopolitical risk does create opportunity for informed investors. But it also means that you need to be strategic about timing your purchases. So whether you're filling your gas tank or buying stocks, similar thing. Okay, now let's talk about Friday's job reports because y'all, this is where things got super interesting. The December jobs report came in showing that we actually added 155,000 jobs. Now, economists were expecting around 160,000, so we came in slightly below expectations. The unemployment rate held super steady at 4.1%, but here's what really matters for your money. So the wage growth number, the average hourly earnings rose 0.3% for the month and 3.9% year over year. So that's actually cooling off, which is exactly what the Federal Reserve wants to see. So how did the markets react? Well, initially stocks went up on Friday, but wait, worse than expected job numbers and the market goes up. Let me explain why this actually isn't crazy. So Wall Street is playing chess, not checkers. A slightly softer job market means the Fed is more likely to cut interest rates this year. Lower rates mean cheaper borrowing costs for companies, which is actually good for stock prices. So the market is basically saying, we'll take a small slowdown if it means that the Fed will start to ease up even more. So here's what this means for your personal finances. Number one, if you're carrying credit card debt, you might see relief this year. When the Fed cuts rates, credit card rates eventually do follow. Though they do lag, it can take several months sometime. Number two, if you're saving for a home, this is actually really good news. Mortgage rates have been hovering around 6.8 to 7.1%. If the Fed cuts rates 2 or 3 times this year, we could see mortgage rates drift down to the low 6% range by the summer, which would be phenomenal. Okay. Number three, if you have been sitting on cash in a high yield savings account or earning 4.5 to 5%, enjoy it while it lasts. Okay. Those rates will come down as the Feds, and if they do continue to cut rates. So your homework this week is first, check what rate you are getting on your savings right now. Make sure that you're in a high yield account before those rates drop, if possible, okay? All right. I am so excited because earnings season has officially started, okay? So this Friday, January 16th, we got big banks reporting. We got a lot of companies this week, and this is when we separate the talkers from the walkers, okay? So here is your watch list for this week, all right? So on Tuesday, actually, we have JP Morgan Chase. Now, this is the biggest bank in America, and their CEO, Jamie Dimon, always gives us insight into consumer spending and the health of the economy. We also have Citigroup this week. So watch their credit card division numbers very closely, especially with the Trump announcement we're about to discuss in a second. Then we have Wells Fargo, who's also consumer banking focused. So their numbers tell us how everyday Americans are managing their money. So why do any of these earnings matter to you, you may be asking? Well, when big banks report, they're essentially giving us a report card, right? On the American consumer. Are people paying bills? Are they taking out loans? Are credit card delinquencies rising, right? If you're invested in index funds like the S&P 500, financials make up about 13% of the index, okay? So these earnings will move your portfolio. Also reporting this week, we have Delta Airlines on Tuesday, and travel spending is honestly a really, really great indicator of how the economy is doing and if people have extra money to spend. We have Goldman Sachs on Wednesday, which is Wall Street's health check, all right? So your strategic move is, first of all, be really careful trading in and out right before earnings, okay? Because that can be gambling, but do pay attention to what these companies say about the future. That is what we call guidance, because that tells you where to position your money for February and March, okay? So if the banks say that consumers are still spending strong, then that's a green light for retail stocks. If they say credit card delinquencies are rising, then it's time to be a little bit more defensive. Okay? Now, let's talk about the announcement that has credit card companies absolutely shook right now. Shook. Okay. So last week, President Trump announced support for legislation that would cap credit card interest rates at 10%. Now, currently, the average credit card interest rate in America is around 24%, and some cards go as high as 30%. So how did the markets react to all this news? How do you think? Credit card stocks got crushed, y'all. They were just falling, okay? We're talking Capital One was down nearly 8%, Discover's down 9%, and Capital One actually just bought Discover. We got Synchrony. They issue store credit cards. They were down 11%. And these companies make billions from interest rates. So a 10% cap would fundamentally change their business model. So what does this mean for you? Well, if this passes, and that's still a giant if, because it needs to get through Congress, this could be the biggest consumer financial protection change in decades, okay? So your immediate action items, and I know we've already covered a lot, it's a lot to do. But number one, if you are carrying high interest credit card debt right now, do not wait for this legislation. It could take months or even a year to become a law. Attack that debt now using the avalanche method, right? Which is the highest interest rate first. Number two, it cautious about financial stocks in the short term. This uncertainty will definitely create volatility, okay? Number three, if you have good credit card companies might start tightening their lending standards now in anticipation. So if you've been thinking about opening a new card for rewards, the window might actually be starting to close. So the reality is credit card companies will find other ways to make money. They could be increasing annual fees, transaction fees, reducing reward program benefits. Free money doesn't exist the way that it used to, okay? So quick hits on what else you need to know, okay? First up, inflation data drops on Thursday. So we get the consumer price index that's be announced for December. We have economists expecting inflation around 2.8%. If it comes in higher, the market could pull back. Lower, then it could be rally time. It has been continuing to consolidate. After a massive 2025, tech stocks are taking a little bit of a breather. Don't panic if you see red in your portfolio this week. This is normal after those big runs, okay? Gold is also hitting new highs. So gold touched $2,720 an ounce last week. If you've been wondering whether to add gold exposure to your portfolio, I say 5 to 10% is reasonable right now, given all of this uncertainty, okay? And then we have our Chinese market watch. So keep an eye on any new stimulus announcements from China. They've been struggling, and any big policy moves will ripple through global markets. So here's your homework challenge for this week. First up, you can always text me at 202-71035 and tell me, are you currently carrying credit card debt? And if so, what's your interest rate? I would love to know, right? I want to know because if this 10% cap legislation moves forward, I'm going to create specific action plans for different debt scenarios, okay? So your responses will actually help me to tailor that content. So thank you in advance, okay? So here's your 3 key takeaways for the week. Number 1, Venezuela, uncertainty equals energy volatility. Okay. So fill up your tank strategically. All right. Number two, the jobs report suggests that Fed cuts are coming. Position your money accordingly, especially if you're house hunting or thinking about refinancing. Earnings seasons starts really today with a lot of big banks and a lot of our favorite companies really giving us insights on what's going on in the economy. So if this episode helped you to understand what's really moving your money this week, do me a favor, share it with one friend who needs to hear this, okay? Financial literacy is a community sport, you guys. If you want to dive a lot deeper, you can join our Demystify Collective where we break down a lot of this stuff and we're really just helping you to understand and to start making your very first investment move. And guess what? It's only $1 to get started. I'll drop the link for you in the show notes. Thank you all so much for tuning in to another episode of Beat the Bell. Dominique, and remember, the best time to build wealth is when you understand what's happening in the markets. See you soon.